You're listening to Carrie Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to and watching the Financial Survival Network. I'm Carrie Lutz. Well, how many times do you hear a story? Somebody goes into a profession, it just doesn't fulfill their needs spiritually, satisfaction, spent all this time in this profession, and then they go to another profession, and that's it. They find their calling. Has that ever happened to you? I'd love to know. Right now, we have a great guest, Pranay, Parikh. Pranay, you are a MD, you are a doctor, you are successful, but it wasn't cutting it for you. So then you found real estate. Usually, I would think most people want their kids to be a doctor, but real estate developer is not so bad, is it?
Yeah, definitely. The question I get all the time is, do you still practice medicine? And I do, I actually do both medicine and real estate, but I've always wanted to be well-rounded and do more than one thing. And, actually when you apply for medical school, they want to know that you're doing something outside of studying. And I was doing a ton of stuff, but after you get in, they kind of weed all that out of you. And I just found my passions again after I graduated.
All right. So real estate's your passion. Hey, where are you making more money, in medicine or real estate?
Ooh, that's a close one. Probably medicine, but that's because real estate, the way we do it is we get paid on the back end. Like, we're the last people to get paid. And we're fine with that because we have investors and we want them to get paid first. So eventually it'll make more money, but not yet.
Well, that's that old real rule. The first money in is the first money out, obviously, except when you're dealing with a hedge fund, of course, and they play by different rules. So I have a close relative, attorney, and day trader, and he's one of the few day traders that actually is highly profitable and makes some years as much money in day trading as he does in law, and he's really successful in law. So it's not bad to have two separate income streams. No matter what happens to the real estate market, people are still going to be getting sick. They're still going to be needing your medical attention, right?
Yeah, totally. And, I find that I'm sure you've heard of the burnout epidemic in medicine. And a lot of people make a binary decision. They're either full-time in medicine or they're out of medicine, and that's unfortunate because we need doctors, and most doctors, I'd say 99% of people are passionate about it. And that's why we spent 20 years doing it, right? And I think if you're able to make money outside of medicine, then you're able to craft your medical career into one you want. Maybe you work 2 days a week. Maybe you work 3 days a week. Honestly, my doctor was well rested, had time to read about the latest treatments, and was only working 2 or 3 days. I'd prefer that over someone that's working 6 days a week and is overworked.
And approaching burnout and prone to making mistakes, potentially deadly mistakes. But the burnout syndrome that you so well summarize, it's real. And especially after the pandemic, it's really put a lot of pressure on physicians. But the nature of practicing medicine has changed dramatically in the United States over the past 30 years. Oftentimes now, doctors used to be in private practice, but now they are working for hospitals or multi-state practices. So it's become a lot more depersonalized and perhaps less gratifying, hasn't it?
Yeah, and it's a systems issue, and a lot of the problem is you lose locus of control, right? So, a lot of times people will say, "Hey, doctor, you didn't spend that much time with me," but we literally spend 3 times, and they've done research on this, 3 times doing notes and computer stuff for each person that we see. And, it kind of sucks that we're not able to spend that time. But if you say you're making money through real estate and it's coming in passively, like our investments, you can say, okay, I'm going to spend an extra 10 minutes with you. I don't really care that I'm not getting paid for that money. I'm fine with that, and I think that financial security that we can offer doctors, and, they can get a lot of ways, but it's really important to helping medicine.
So you're kind of a real estate concierge for doctors, if you will, right?
Yeah, and that's a great way to look at it because there's so many different ways to invest in real estate. When I started many years ago, I was like, okay, I can figure out this real estate. And honestly, you can. If you're a doctor, if you're pretty much anyone can figure out real estate. And I bought my 4 unit. It was going great. And I spent time trying to buy another one and I spent hundreds of hours trying to find the right property and it was just wasted. And I was thinking, if I would have worked at my day job for this time, I would have made a lot more money. And so that's why we went passively, right? Where you invest with experts that do real estate. We partner with the best and they do the day to day, and we kind of manage the managers. And, us doctors, we have a lot of dentists, engineers, lawyers. We're good at managing. We just don't have the time to pick the bathroom tile, answer phone calls and all that stuff.
Well, my father always used to say that anytime you go into a new business, you're going to pay for lessons, not necessarily out of pocket, but in terms of time, how much your time is worth, opportunity cost, all those things. So break down a typical deal that you would do and what type of returns can you realize from it?
Yeah. So we actually just closed a deal. It was in Oklahoma City, 312 units. So, we buy pretty large properties. And because of that, we're able to get economies of scale. So we have on-site property management. Our real estate partner, they've sold, not bought, sold $1.7 billion worth of real estate. They currently own $2 billion. So they've been around the block. The reason we did this deal is we got a fixed debt at 2.9% for 9 years.
That's great.
Yeah, everyone knows it's like in the sixes now, plus 4 years of interest only. So
Even better.
people invest with us. We kind of we find a deal, we vet it, we negotiate it. And the returns for this one, we do IRR. So it's, it looks at money and how fast it comes back to you.
Internal rate of return.
Yes. And we were aiming for net. So after all our fees, after everyone's fees, promote and everything, money in your pocket, about 17 to 19% IRR. And an equity multiple, so a multiple of your money invested, about 1.8. So if you put in 100,000 after about 4 years, which is our projected hold time, you would get 180,000.
So almost doubling in 5 years effectively.
Mm-hmm.
What's the strategy here? Are you going to keep the property and refinance it and raise rents as market conditions allow? Or is there an exit strategy after the, certain period of time?
Don't just survive, thrive. The Financial Survival Network.
Torque Resources is an exploration company establishing a portfolio of premier copper gold early stage projects in Chile. Torque's management and technical teams have a strong track record of raising capital, discovery, and monetization of exploration successes. The company's Margarita Copper Gold project is located within the prolific coastal Cordillera Belt in Chile, which hosts some of the world's largest and most profitable copper mines. The Margarita project possesses excellent discovery potential for a major copper discovery due to the strength of the alteration system, large-scale magnetic targets, and the presence of copper oxide mineralization. Drilling is anticipated to begin in Q3 of this year. Torque trades in Canada under TORQ and on the OTC under TRBMF. To learn more, go to torqueresources.com. That's torqueresources.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
Yeah, so we tend to prefer shorter hold times. So what we do is we're currently renovating. The plan is to sell the property in 4 years. Sell it to institutional like Goldman Sachs, Blackstone, and we do what is called value add. We go in and renovate it, and then sell it to a big company because they aren't able to take the risk, even though it's minor, of doing some renovations. They want something that's nicely
Turnkey.
packaged with a bow.
They want a turnkey, sure. Hey,
Exactly.
what's the cap rate on the property when you bought it, and what was the occupancy rate?
Yeah. So the cap rate when we bought it was 4, which is pretty good these days. A lot of cap rates are on the lower side. We've seen and bought things in the 3s. It's hard to say what's going to happen in the next few years. We predict a much worse cap rate on exit, so over 4.4. So we're assuming things are going to get worse, and it's still going to be a pretty good property and make us profit.
Right. And was it
Mhm.
fully occupied when you bought it? You said it was
Yeah,
value add.
yeah, it was 92%. Yeah. So not
That's pretty good.
not completely stabilized, but we like there to be a little meat on the bone. If it was 97%, it means that
Fully valued. Yeah.
yeah, exactly.
92 means they're not maximizing value, even though it's 5%. Doesn't sound like a lot. That's 15 units that are constantly open, and you're going to have a vacancy factor no matter what. Yeah, so you did a value add. How much did you put into each unit when you did it?
Yeah. So we're gonna put in about 12,000.
12,000. So that's enough to fix up the kitchen, new appliances, probably retile the baths, maybe replace fixtures. Right? Basically, that it.
Yeah. So mostly cosmetic.
Cosmetic. So it's not like a gut reno.
Yeah, stuff that is going to move the needle. So, floors, the
Aesthetic.
kitchen, the bathroom, those are the things people really care about.
Mm-hmm. And then you do some aesthetics on the outside as well. You
Clubhouse, the
reseal
gym,
the parking lot, paint the stripe it, and the gym and all that. Everybody's happy. I mean, the tenants know that their rents are going up regardless, but at least now they can see they're getting more for it. So are you renovating the units upon renewal of the lease, or okay?
Yeah.
Yes.
We're trying to aim for about 10 a month.
Okay. I like it. So obviously you're making fees and things off of this, but you got to keep your fees reasonable, because otherwise it's going to nick the IRR and it's going to be less desirable to investors, right?
Totally. Yeah. We try to keep everything very reasonable. So when we work with the operator, we kind of look at a holistic picture. So, what are the total fee burden of everyone? And we try to keep them minimal, because, it sucks paying fees, and especially upfront fees. So we try to do what's the least amount we can do to take care of operations, and then the rest of the money. And that's why I was saying I don't make that much money from real estate yet, because our money's on the back
You're in
end.
it for the long haul. You're going to share in the appreciation at the other end.
Exactly.
So pandemic, this been multifamily investing has been a phenomenally good investment up to now. We'll see with rising rates what happens. How many deals have you packaged, Pranay?
Yeah, so we did 3 alone this year. So we've raised over 40 million, mostly from doctors. But, that's because people are trying to chase yield. And the safe place, just like you said, the safe place to put it right now is multifamily, because people need a place to live. They don't necessarily need an office. They don't necessarily need to go to Walgreens. And the stock market, funny story about the stock market, I bought the first dip, I bought the second dip, I bought the third dip, and the fourth dip, I ran out of money, and it keeps dipping.
Hey, well, the old saying, how do you make a small fortune on Wall Street? Start with a large one.
Yeah.
So, but real estate, at least more in your control. There's less intangible value there, and it really comes down to the numbers. So when you can find these, it doesn't sound like you're doing the gross value adds where, grossly undervalued because they're like 50% occupied. But when you can find those guys where 10%, 5% more occupancy, sometimes I've seen it where there's land in some of these areas that hasn't been developed in these projects. And then you can throw in a couple extra buildings there too, or some retail or whatever. So you're looking for an edge. You're just not buying 97, 98% occupied projects, right?
Yeah, totally. And our biggest concern is downside protection, right? So especially now, but it has always been our focus. So if we try to look at what's the worst that can happen, and so let me give you an example. So for this Oklahoma City, the worst occupancy for the city is 92% for apartment complexes. So so that means a vacancy of 8%, right? So we said, okay, let's double that. Let's triple it. So if we have 24% vacancy, are we still able to cover our mortgage payments and all our costs? And our break-even occupancy, the amount of occupancy that we need to have to break even is 66%. So even if you 3 times the worst ever vacancy, we're still doing well. So that's what we focus on.
Yeah. Hey, so are these Class B properties or C plus? What are they?
Yeah, like a B minus. Yeah. So it's we call Class B the Goldilocks, right? So Class A is Manhattan, downtown LA, where I live, the really nice ones, right? And when there's a recession, those people will go down to Class B. Or, and this is happening a lot right now, people are wanted to buy a house, but are getting priced out, right? Because of the increase in mortgage rates. So then they will go to Class B. And then when the economy is doing well, the people who are in the Class C, the Crenshaw, the area of Inglewood, which actually Inglewood is pretty nice right now, but they'll upgrade to Class B. So it does well. It's kind of a bellwether. It does well in both sides of the economy.
Yeah. Class A, and I remember, 7, 8 years ago, 10 years ago, Class B, you could find cap rates 7, 8% on it. So they've gone down, which means effectively they've more than doubled in that period of time. And we know the story. Well, I know you're going to want to find out more about what Pranay is doing. Pranay, people want to find out more about you, connect with you on the web. How do you do that?
Yeah, so I'm very easy to get a hold of, Pranay at ascentequitygroup.com. And we actually created a page with some resources for your audience, fsn.ascentequitygroup.com.
All right.
There's a little video on there explaining real estate and, a way to get on my calendar.
All right. I like it. I'm sure we're going to talk with you again. Hey, what are you guys doing out there now that rates are going up, yields are increasing? You still so bullish on real estate out there? Why don't you let me know? Send me an email, kl@kerrylutz.com. Don't forget when you go to the website, financialsurvivalnetwork.com, just send us, click subscribe, and you will receive our weekly newsletter, which will not be published next week because I will be away. But after that, I promise the day I get back, you'll get one. Pranay, really great to meet you. Good luck, and we'll talk to you again soon.
Thanks, Kerry.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.